What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to the fourth and final episode of this little mini series that we are doing here on the channel, where I rank every single Dividend King stock and let you know if I think any of them are worth investing in at today's prices. Like I said, today is part four. It's the last video of the series. You guys made it all the way through. We're gonna jump into a lot of other different unique videos coming after this, but let's finish up this mini series. If you guys haven't seen parts 1, 2, or 3, I'll leave links for those videos down in the description. But today we're finishing up with stocks number 31 through 37, and we're going to do a rapid fire style. Let's go ahead and jump straight into it. And starting here with stock number 31, we've got Emerson Electric, ticker symbol EMR, who isn't a super well-known company to the average consumer. However, it is likely that one of their electrical products has powered something that you tend to use typically in your everyday life. See, Emerson components are used by pharmaceutical companies that make your medicine. They're used in air conditioning and HVAC systems in large buildings and even residential homes. Their valves and automation products are used by large manufacturing companies and oil and gas companies for various purposes. The list really goes on and on. And on one hand, this large dependence on various businesses does leave them fairly exposed to the macroeconomy, which caused their sales and profits to both fall during the 2020 lockdowns. But on the other hand, they're pretty well diversified across multiple different industries, and that's allowed them to bounce back in 2021 and still be expected to grow by another 6 or 7% in each of the next 2 years as well. It's also allowed them to grow their dividend every single year for over 6 decades in a row, even through the worst economic downturns of recent history. Now, the yield isn't very high at just around 2.3% with a low growth rate, but considering that the stock is currently down around 15% from its highs, this might be one of the better times to buy into the stock if you want a dependable long-term dividend option. For me though, the business is too boring and the dividend is too small with too little growth, so it's going to be really an average kind of Dividend King stock for me overall. There's both better and also worse options out there in the market. Moving on though to stock number 32, we've got Parker Hannifin Corp, ticker symbol PH, who is best known for being one of the many suppliers to Boeing, which is one of the reasons why the stock has been a little volatile in recent years, which I'll show you in just a second. But more importantly, Parker is just an industrial technology company overall, whose products and components are typically associated with things like hydraulics, filtration, electromechanical, process control, all sorts of different things that are heavily used in markets like aerospace, construction, oil and gas, transportation, power and energy, mining. The list really goes on. It's definitely a needed service that I don't think is ever going away, and it's one of the reasons why they've been able to classify as a Dividend King for so long. But it's also a business that is heavily dependent on the success of other businesses, and that's why the 2020 lockdowns with the suspension of travel really hurt them in 2020, causing their sales to drop by 4% before bouncing back by 5% last year, and still expected to grow another 10% and 7% in each of the next 2 years respectively. As I mentioned before, the stock has been a little volatile in recent years as it's currently near a 52-week low, but is still up over 75% in the past 5 years. Now, overall, I think it's looking pretty good since the valuation is about the same as the sector, and that's despite paying a very good growth oriented dividend that has about a 2% yield with a super low payout ratio, a double digit growth rate, and 6.5 decades of consecutive growth. My only concern is that I think the macroeconomy looks weak right now, so my gut tells me that this stock will fall a little more from these levels, as it can sometimes be a little cyclical too. But I definitely like them a lot more than the last stock we looked at, so I'm gonna be generous and I'm gonna give them the above average ranking, even though it's not really a stock that I'm interested in buying myself, because I think it would be really too hard to keep track of their business just because they have so many different products and components that they sell across so many different industries. It's just not a very exciting business to me, but it's also one that is just very hard to keep track of. So I'm not going to buy it, but I'll be nice and I'll give them an above average ranking. Moving on though to stock number 33, we've got one that I actually am very interested in their business, and that is American States Water Company, ticker symbol AWR, who, as the name implies, they produce and sell water with over 260,000 customers, primarily across California, and they're even an electric utility, primarily in the Big Bear region. And the reason why I like this business is because literally everyone in the entire world will always need water. That is probably the most essential, like most reliable product you could ever sell. And the nice thing about AWR is that their largest customer is actually the US government, who's already rewarded them with multiple 50-year contracts worth hundreds of millions of dollars, which shows just how reliable of a business this is and how high the demand is. As a result, their sales and profits are super stable, even climbing during the 2020 recession, and are still expected to grow by another 4% both this year and the next. Granted, that's not very high growth to brag about, but it's super consistent, which has allowed them to grow their dividend for 6.5 decades in a row. And my only issue is with the stock itself, though. The dividend yield is pretty low at less than 2%. And while the stock price is currently trading near a 52-week low, it's still really expensive compared to the rest of the sector at around 50% higher. I love the business and I would love to own the stock, but the financial growth is too low, the stock price is too expensive, and the dividend yield is too small and too low growth to really make up for any of that. So I'm going to have to rank them as average overall. It's a good long-term option, but I think you can get some bigger gains from some other stocks if you're willing to look around. That brings us now, though, to stock number 34. And for this one, we've got Dover Corporation, ticker symbol DOV, who is yet another type of industrial machinery kind of related company. In many cases, they're working with different fueling solutions like pumps and processing for oil and gas. But they also do things like refrigeration for food. They work in solid waste handling. They work in aftermarket vehicle repair or industrial automation. They do work for aerospace and the military. It's really a number of different things, and they kind of remind me of Parker Hannifin in a lot of ways, which we looked at earlier. But like Parker, they too saw a dip in their financials during the 2020 lockdowns, but they quickly bounced back from that and are now experiencing growth again of around mid to high single digit percentages per year. The stock itself is up over 100% in the past 5 years, but most recently they actually dipped back down by about a quarter of their value, leaving them near a 52-week low. And as a result, they're actually trading slightly cheaper than the sector, which is good. However, the dividend is not that great. The yield is very small at less than 1.5%. And while it does have a very low payout ratio, the growth rate is still in the single digits. So I'm not convinced that it's going to grow by a lot in the coming years, especially with how weak I feel that our economy looks right now. As a stock itself, without the dividend, it does look attractive, but as a dividend king stock or as something where you actually care about the dividend, it's really mediocre at best. So I'm going to have to rank them as average here too. All right, we are now down to the final three stocks. So let's see if we can work some magic here and try to finish this mini series with at least one really good dividend king stock. But coming in at number 35, we've got Genuine Parts, ticker symbol GPC, who is generally considered to be a little cyclical just because of how reliant they are on the auto industry, which we all know that, the automobile industry can be very cyclical just on its own. But what GPC basically does is they're split up into two businesses that focus on the automotive industry, and then they also have another part of their business that is just focused on the broader industrial market overall. And on that broader industrial side, they supply the market with all sorts of products like bearings and transmission equipment and hydraulics and various machinery parts and stuff like that. But you've probably heard of this company through their automotive part of their business, because they're famous for owning all of those Napa retail stores that sell various replacement parts and service products for automobiles. And of course, they're also famous for those Napa Know How commercials. Of course, we all know that the world shut down in 2020, though, and the automotive market got crushed because people weren't even traveling, and that caused GPC's sales and profits to both drop that year before they saw a large recovery in 2021. And then still another big surge is expected this year of 12% before they finally fall back down to the low single digit growth rate next year, which is where you would typically expect to see a company like this be growing, kind of in that range. Stock-wise, though, it got destroyed in 2020, but then skyrocketed right after, leaving it now up over 40% in the past 5 years and currently sitting around the midpoint of its 52-week range. So pretty middle of the road, I would say, performance wise for the stock. It's not that great. You definitely could have got better results just from the S&P 500 on its own, but the dividend is fantastic with a 2.7% yield and a low payout ratio. It would have been really nice to buy it though during the 2020 crash, because not only would that yield have been a lot higher, but the big recovery after has now left their PE ratio around 50% more expensive than the rest of the sector, which is a pretty big red flag for me, especially considering the poor stock performance. I just really don't want to pay a premium for a business that relies so heavily on automotive retail. I think with the rise in gas prices and the better performance of EVs, the auto market is going to continue shifting away from ICE vehicles in favor of EVs, which I don't really think will benefit these traditional auto parts retailers. EVs tend to have less components and require a lot less maintenance. I think the average gas car has like 30,000 components, while an EV has around like half that amount. And even when they do break down, the owner typically goes to a professional shop that actually knows how to work with EVs rather than trying to fix everything themselves. So I just don't see a lot of high growth for the future of GPC, of Genuine Parts, this company. Don't get me wrong, I don't think their business is going away anytime soon, and I'm sure they'll find ways to adapt to a changing market. But overall, it's not as a reliable business as some of the other stocks that we've seen on the list. So even though I do really, really like the dividend, I'm actually going to rank them as below average for the reasons I just mentioned. Okay, we're now down to the final two stocks, and coming in at number 36, we've got Northwest Natural Holding, ticker symbol NWN, which is primarily a gas utility company that provides natural gas to residential, commercial, and industrial customers, mostly throughout Oregon and Washington. It's a utility, so you get that typical low but reliable growth every year, usually around a mid single digit percentage, which is pretty good. But because they're so heavily reliant on natural gas, which is actually a lot more environmentally friendly than people realize, but the whole kind of climate change movement has really favored solar, wind, and water over natural gas, and that's caused some volatility in the stock, as it's actually negative over the past 5 years and down about 20% over that time. With that horrible performance, though, you better be getting a super cheap valuation with an amazing dividend. And unfortunately, that's not really the case here, at least not in my opinion. The PE ratio is only a bit lower than the sector, while the PEG ratio is actually more than 20% higher. And while the dividend yield is pretty good at 4%, the payout ratio is also high, while the growth rate is practically zero. In other words, what you get right now is probably what you're going to get in the future in terms of the dividend. And I'm just not convinced that a 4% yield is enough to make up for that horrible performing stock price that is still valued about the same or maybe even more expensive than the sector, depending on how you look at it. So I'll be nice and I'll give them a below average ranking instead of a really bad one, because they at least have consistent financial growth and the yield is pretty good on the dividend, but everything else is just very unattractive to me. So below average, that's how I feel about it. Finally, though, that now leaves us with the last dividend king stock to cover. And coming in at number 37, we've got a stock that a lot of people actually like because they feel it's very recession proof. So let's hope that it gives us some good results here. But that's going to be Procter and Gamble, ticker symbol PG, which is actually a very popular stock. A lot of people tend to own it. I've had a lot of people leaving me comments down below many times telling me that they own Procter and Gamble stock. And a lot of the reasons why people tend to like it is because of their popular brands. For example, they own Bounty paper towels, Charmin toilet paper, Pringles chips, Downy fabric softener, Tide and Gain laundry detergent, Dawn detergent, Duracell batteries, Crest and Oral-B dental care, Gillette shaving, Pampers diapers, and the list goes on and on. I could really keep talking about it. They even own Iams dog food. But the result of all of that is super strong financials every year, with last year alone doing over $76 billion in sales and over $14 billion in profits. And sales continue to grow by around 5% or so, even coming off of the higher growth that they saw during the pandemic when everyone was panic buying their products. Unfortunately, though, the solid financials and the high brand strength means that the stock rarely ever dips and is currently up over 80% in the past 5 years. Now, you might really like that if you already own the stock, but if you're currently out of it like me, it might be hard to find a good entry point to get a low valuation and a high dividend with this one, because currently PG trades significantly higher than the sector on practically any metric you look at, and the dividend yield isn't very high at just the low 2% range with a mediocre payout ratio and growth rate to go along with it. I know that a lot of people love PG stock, and I can't really blame them when it performs so well and rarely ever dips, but I just think at today's prices, your gains are not going to be anywhere close as high as they could be if you traded a little more risk for some higher growth potential like you can with many other stocks in the market. So I'll rank them as average because that's just how I truthfully feel about this one. I think they're a solid choice, but I'd rather own many other stocks instead. That does it though for our list. To summarize our last 7 stocks that we had here for this series, we've got unfortunately 0 stocks in the really good category. We did manage to get 1 stock at least in the above average category with Parker Hannifin. We got a whopping 4 stocks in the average category with Emerson Electric, American States Water, Dover Corporation, and Procter & Gamble. We also got 2 stocks in the below average category with Genuine Parts and Northwest Natural. And luckily, we at least didn't get any stocks in the really bad category. But overall, I would say that this was a very disappointing way to end this Dividend King mini series here. Really not any stocks on today's list that I found very interesting or worth investing in. You guys let me know down below if you disagree or agree with any of my thoughts on this, but I think we definitely had some better options in previous episodes of this mini series. And overall, I'm just kind of feeling like Dividend King stocks, they tend to not be so exciting. They're just kind of reliable, steady businesses that will continue to grow their dividends, excuse me, over time. But you're not going to typically get some huge gains from them, with maybe a couple exceptions here and there. But like I said, I do own some Dividend King stocks myself, as I mentioned in previous episodes. So make sure you look through those videos if you want to hear my thoughts on those. But I hope you enjoyed this series, and let me know down below, do you own any of these stocks? And is there any other type of mini series that you'd like me to do on the channel? I'd love to do that for you guys. But we're moving on to different types of videos after this one. So I hope you guys enjoyed it, and I will catch you guys in the next video. Hope you're all doing well. Take care. Bye-bye.